Hello and welcome to our final quarterly review of 2019. I'm Darrell, Head of Investments here at Valley National Financial Advisors. The fourth quarter of 2019 helped the S&P 500 push forward to its largest annual return since 2013. Throughout the year, volatility remained low as markets were bolstered by an easing of central bank policy as well as robust consumer confidence. We often stress to investors that long-term equity performance tends to closely track earnings growth. And this year, there was a bit of a divergence between corporate earnings growth and price returns on the S&P 500. The S&P 500 returned close to 30% on a price-weighted basis, despite lackluster earnings growth. So moving forward, we expect that 2020 is going to be an important year to watch earnings growth. Analysts are calling for just short of 10% earnings growth in 2020, and it's going to be important that we actually achieve that in order to sustain current and recent levels of return. So we expect things to remain stable, but a tempering of expectations may be required moving forward. The response by central banks around the world to softening economic growth in 2019 was largely a boon for bond investors as well, particularly throughout the first 3 quarters of the year. But in the fourth quarter, we started to see some of that economic data firm up again and interest rates began to rise. Rates across the yield curve are largely influenced by expectations for growth and inflation moving forward. And with the unemployment rate near its lowest level since the 1960s, and an increase in wage growth actually beginning to appear, it's possible that an uptick in inflation could be expected. And if that happens, and to the extent that it's significant, we could start to see interest rates continue rising next year. The healthy returns achieved throughout 2019 made it one of the best years of the current market cycle. Remarkably, this is the exact opposite of what we observed during 2018, when almost all asset classes exhibited losses. Throughout the last 2 years, diversification, or the benefits of diversification, have been harder to see because many assets that have historically moved in opposite directions have moved more in lockstep. If that trend continues, it could pose challenges to investors moving forward because the diversification benefits of bonds may not be quite as powerful. The good news, however, is that during the fourth quarter we saw economic growth beginning to firm up again, and that decreased the probability of recession in the near term. With that, it looks like the main risks to the market will remain geopolitical at this time. And we always remind investors that geopolitical risks tend to pose problems for the market over a much shorter period of time than those that surface as a result of concerns over recession. Speaking of geopolitics, the first few days of 2020 brought some volatility as a result of a U.S. airstrike that killed an Iranian general outside of Baghdad. We wrote about this in our most recent weekly commentary and would refer you to that for our latest thoughts. But until then, this has been our Q4 2019 market update. Thanks for joining us.